journey in your last two. I swim with tea when they turned in. The styron down to mute. And can learn the pole that some kid died.
Let's bring the grip concept into a real-world scenario. Meet Amco Windows and Doors Limited, a growing Canadian corporation owned by Frank and Enzo. Both owners are actively involved in the business, earn salaries of $120,000 each, and are now looking for an additional way to withdraw profits from the corporation through dividends. To determine what type of dividends they can pay, we first need to understand how GRIP was created over time. Let's follow Amco's journey over 3 years. In year 1, the company earned $300,000 of taxable income because the entire amount was below the small business deduction limit. All of the income was taxed at the lower small business corporate tax rate. As a result, none of the income was taxed at the general corporate rate. And since GRIP is only created from income taxed at the general corporate rate, the corporation ended year 1 with no GRIP balance. No GRIP means no eligible dividend capacity. Moving to year 2, the company continued to grow and earned $400,000 of taxable income. However, this amount was still below the small business deduction threshold. Once again, all income was taxed at the small business rate, and just like year 1, no income flowed into the GRIP pool. The result was exactly the same. GRIP remained at 0, and the corporation still had no ability to pay eligible dividends. Now let's look at year 3. This is where everything changes. Amco's taxable income increased significantly to $800,000. The first $500,000 continued to qualify for the small business deduction and was taxed at the lower small business rate. But the remaining $300,000 exceeded the small business limit and was taxed at the higher general corporate tax rate. For the first time, Amco had income that qualified for GRIP. This general rate income began flowing into the GRIP account, and the corporation started building eligible dividend capacity. That's why the GRIP vault on the right side of the slide begins to fill for the first time. And this illustrates one of the most important concepts in corporate tax planning. GRIP does not come from income taxed at the small business rate. GRIP only begins when income is taxed at the general corporate rate. As a corporation grows and earns more income above the small business deduction limit, its GRIP balance grows as well. And as GRIP grows, the corporation gains the ability to pay more eligible dividends to shareholders. The key lesson from this slide is simple. If all of a corporation's income is taxed at the small business rate, GRIP remains 0 and no eligible dividends can be paid. But once income begins to be taxed at the general corporate rate, GRIP starts accumulating and creates valuable eligible dividend capacity for future tax planning. In the next slide, we'll calculate exactly how much GRIP Amco created in year 3 and determine how much eligible dividend the corporation can actually pay. In the previous slide, we saw that Amco did not generate any GRIP in years 1 or 2 because all of its income was taxed at the small business rate. Year 3 is where everything changes. Amco's taxable income increases to $800,000, pushing the corporation beyond the small business deduction limit. As shown on the left side of the slide, the income is now split into 2 portions. The first $500,000 continues to qualify for the small business deduction and is taxed at the lower small business rate of approximately 12.5%. This portion does not create any GRIP. The remaining $300,000 is taxed at the higher general corporate tax rate of approximately 26.5%. And this is the critical piece. Only income taxed at the general corporate rate contributes to the GRIP balance. Now let's move to the center of the slide. To calculate GRIP, we apply the standard GRIP conversion factor. We take the $300,000 of general rate income and multiply it by 0.72. $300,000 multiplied by 0.72 gives us $216,000. This creates a GRIP balance of $216,000. Think of this amount as eligible dividend capacity. It represents the maximum amount of eligible dividends that the corporation is allowed to pay based on its accumulated GRIP. On the right side of the slide, we can see that capacity stored inside the GRIP vault. The vault now contains $216,000 of available GRIP. This is the first time Amco has accumulated meaningful eligible dividend room. And this is why year 3 is such an important turning point in the case study. For the first time, Frank and Enzo have access to eligible dividends, which generally provide more favorable personal tax treatment than non-eligible dividends. The key concept is shown at the bottom of the slide. GRIP balance determines maximum eligible dividends. Because Amco's GRIP balance is $216,000, the corporation can pay up to $216,000 of eligible dividends, not $220,000, not $300,000, exactly up to the available GRIP balance. Anything beyond that creates potential problems, which we'll explore in the next slide. So the main takeaway here is simple. Only income taxed at the general corporate rate creates GRIP. Amco generated $300,000 of general rate income. Applying the 0.72 conversion factor created a GRIP balance of $216,000. And that $216,000 now represents the corporation's maximum eligible dividend capacity. In the next slide, we'll see how Frank and Enzo can use this GRIP balance for dividend planning, and what happens if they accidentally exceed it. Now that Amco has built a GRIP balance of $216,000, Frank and Enzo can finally begin using that GRIP for dividend planning. But here's the critical point. GRIP is not just a number on a tax schedule. It represents the corporation's maximum eligible dividend capacity. Think of the GRIP vault shown at the top of the slide as a container filled with eligible dividend room. In Amco's case, that room equals $216,000. The question now becomes, how much eligible dividend should the corporation declare? Let's look at the two possible outcomes. On the left side of the slide, we see the correct approach. Amco declares $216,000 of eligible dividends. This amount is fully supported by the available GRIP balance. As a result, the corporation stays within the rules. Frank and Enzo benefit from the lower personal tax treatment associated with eligible dividends. There are no penalties, no compliance issues, and the dividend strategy remains fully tax efficient. This is exactly how GRIP is intended to be used. Now let's look at the right side of the slide. Suppose Amco decides to declare $300,000 of eligible dividends instead. At first glance, this may not seem like a big difference, but the corporation only has $216,000 of GRIP available. That means the eligible dividends exceed the GRIP balance by $84,000. And that's where the problem begins. When a corporation pays eligible dividends beyond its available GRIP, it creates an excess eligible dividend. This triggers Part 3.1 tax, often referred to as the excess eligible dividend tax. The penalty is calculated at 20% of the excess amount. In this case, the excess is $84,000. 20% of $84,000 results in a penalty tax of $16,800. That's a costly mistake for simply failing to check the available GRIP balance before declaring dividends. This is why tax professionals always follow the process shown in the Schedule 53 dashboard on the right side of the slide. Before declaring eligible dividends, they verify the current GRIP balance. They compare the planned dividend amount to the available GRIP, and they make sure the corporation does not exceed its eligible dividend capacity. This simple review process can prevent significant penalties and protect shareholders from unnecessary tax costs. The tax planning strategy at the bottom of the slide summarizes the professional approach. Use eligible dividends up to the available GRIP balance. Avoid exceeding GRIP. And always review Schedule 53 before declaring eligible dividends. The most important takeaway from this slide is one rule that every tax preparer should remember. GRIP is your eligible dividend ceiling. As long as dividends stay below the available GRIP balance, the corporation remains compliant and tax efficient. But once eligible dividends exceed GRIP, penalty risk begins immediately. For Frank and Enzo, the optimal strategy is clear. Use the available $216,000 of GRIP wisely, stay within the limit, and avoid unnecessary Part 3.1 tax penalties.